You're listening to The Real Investment Show.
What's really kind of fascinating to me is that the morning last year, I came in here and we had to do an emergency broadcast alert because of the Japanese yen carry trade blow up that was occurring. And markets were down 2% in the morning because of that. And that morning, immediately out of the gate, we had like 1,500 viewers on YouTube, and the number of emails of concern and comments that were being made, et cetera, were just at abnormally high levels. This morning, I kind of expected the same thing. I said I got a lot of emails yesterday about the attack on Iran, but I expected a lot more fallout. Like when I woke up this morning, I expected my inbox to just be completely flooded with emails, because that's what happened after the carry trade. And that's not the case this morning. Very normal this morning in terms of kind of email flow, comments on, social media channels. Appreciate y'all being here. There's, 500 of you here in the chat already this morning, our viewers, and I certainly appreciate that very much, but not that sense of urgency. And I think that's an important thing to think about when we're talking about what's going on, is that investors are becoming much more adept at navigating markets and starting to understand a bit more about how markets respond to certain aspects and certain events. Because we've had a lot of these events over the last 15 years in particular, just going back to the financial crisis. And we're starting to see, even though there's just a ton of videos that were put out over the weekend talking about World War III, and this is terrible for the markets, and this is going to be the kind of the end game scenario for the U.S. And I saw just tons of these kind of headlines and things, but yet this morning the markets again down. They're down slightly right now. The NASDAQ is down 35 points. Bitcoin's sitting flat-ish. It's up a little bit at 100,000. Dow's down 68 points. This is not what you would have expected on this type of news headline. And again, when I got up this morning and was looking at headlines, before I started the show this morning, futures were actually slightly positive. So, I mean, they've sold off here a little bit. S&P's down 7 points right now. That certainly, again, that's not the type of reaction that you would expect from this type of event. And that's okay, right? There's again, investors are becoming much more adept at kind of navigating some of these headlines, because, again, the one thing that it matters for the markets is that how does it affect earnings? But the other side of this is that positioning in the markets is not aggressive. Retail investors have gotten pretty aggressive with market exposure, but if you take a look at consolidated equity positions across portfolio managers, you take a look at the computerized trading algorithms, the CTAs, you take a look at their positioning, take a look at the systemic kind of traders, guys that are trading very system-based programs. They're all about neutral. They're not aggressively exposed to markets. In fact, they're underweight equities more than you would expect, given this rally we've had in the markets from the April lows. So there's not a lot of offside positioning. In fact, there's more positioning that needs to get into the markets right now than out from a professional basis. And that's where most of the money is. Retail investors are fine. They're overly invested right now. But again, that's a much smaller aspect to the overall market than the institutions are. And institutions are underweight. So that underweighting of equity exposure, you don't have that aggressive positioning that needs to be sold off to rebalance risk because of some type of event like this. So that's one aspect that is holding up the market here from being probably, or possibly at least, much more direly impacted this morning. Now, having said that, that doesn't mean we're out of the woods by any stretch of the imagination. There is still risk. again, what happens next? So couple of things we've got to be paying attention to. The Strait of Hormuz, as we talked about a second ago, if Iran closes that's 6 miles of water that is a choke point for oil deliveries. Now the U.S. does not get a lot of oil from the Strait of Hormuz. Most of that goes to China. But it does potentially impact the price of oil. So if the Strait of Hormuz is closed or something else occurs, we could see a much sharper spike in energy prices. And again, oil prices have certainly risen over the past few weeks as this whole Israel-Iran kind of conflict has risen. But we're not seeing oil prices spike off to the moon by any stretch of the imagination. In fact, we touched on that in this weekend's newsletter. If you haven't read it, this weekend's Bull Bear report goes through the impact of oil prices. But my take was a little bit different there because, again, that related more to the Fed meeting. The recent Federal Reserve meeting, Jerome Powell kept saying, hey, we haven't seen any impact of tariffs, but it's coming, right? The tariff inflation is coming. And a big part of their issue is that they are so tied up in their concerns over transitory, inflation that they're now overcompensating for tariff inflation. But they're likely to be vindicated. We've had 4 straight months of inflation being much lower than expected, even though we've had tariffs. And they're likely to be vindicated now because we'll likely see an uptick in CPI because of this recent rise in oil prices. But the recent rise in oil prices is not dramatic. We're still well confined within a longer-term downtrend in oil prices back from the previous spike we had to around $100 a barrel. So, but again, if the Strait of Hormuz closes, there's certainly a scenario where we could see $80, $90, $100 barrel oil pretty quick, just over concerns of that happening. And, so that's one impact to markets. We'll certainly see it show up potentially in inflation over the next couple of months. We'll see a slightly hotter print. But oil prices is certainly something that would weigh on the U.S. economy and potentially hurt earnings because of a decline in U.S. demand if oil prices do spike. So it is something that we need to pay attention to. When we come back, we'll talk a little bit more about, the situation in Iran right now, kind of where we are, what happens next potentially, or what the concerns are, and kind of how to navigate the market from where we are right now. Don't go away.
You're listening to The Real Investment Show.
And welcome back to the show this morning. So again, just talking a little bit about the World War III in Iran. If you want to know how this plays out, just watch Top Gun Maverick. All weekend was my social media feeds were just the scenes from Top Gun Maverick. Says, here's the bird's eye view of the bombing in Iran, because that was the whole premise of the movie. They were knocking out the nuclear facilities, in that movie. So, but that was my whole feed this weekend. So apparently that's all you have to, if you want to know how this plays out, just watch the movie. You'll be fine.
That and snippets from games.
Yeah.
Video games. Yeah.
Yeah, exactly. So yeah, this has been played out long, and importantly, this is not our first intervention with Iran, right? This whole, nuclear treaty. Remember back during the Obama administration, John Kerry went and negotiated the nuclear deal, right? The deal with Iran. And in that deal, they said, okay, we're not going to enrich our uranium, wink, wink, nudge, nudge, and you give us $150 billion in cash on pallets brought over by midnight, in planes, and release some of your hostages to us. And, that was supposed to solve the whole problem. Of course, that's Iran's game, right? Iran has always been the better negotiator at this. Like, oh yeah, we'll do this. And then behind the scenes, they just keep doing what they're doing to, build their nuclear program. And so this is not the first time that we've been in this situation. You go back to this is not the first time that there's been conflict between Iran and the U.S. of any sort. This has been going on since the 1980s. So, this is not new to markets, what's going on right now. The big concern, of course, over the weekend is that this is the event, right? And this has always been the concern, is that every time something happens, like, oh, this is going to start World War III, and it doesn't. These things calm down in fairly short order, and everything kind of goes back to status quo. Everybody gets back on their side of the fence and, goes back to doing what they're doing. And this isn't, this isn't going to stop Iran from building nuclear facilities or nuclear capability. It's going to set them back, obviously. But the next time they do this, they'll just build the bunker deeper, fortify it better to avoid bunker buster bombs, right? I mean, this is going to set them back a decade or so, but we're going to be back in the situation with Iran at some point in the future. That's just the nature of how this is going to work out. So again, what we have to do as investors is to step back and go, what does this actually mean? And again, there's the one contingent of people in the media that are spinning this to be the worst possible outcomes. This is the beginning of World War III. This is going to be this, that, or the other thing. That's probably not the case. And again, if we put things on a bell curve distribution of what is most likely to happen versus the outliers, what happens in the middle is the probable outcomes of this situation. And so what's on the tail risk events, right? What could happen but are very remote possibilities. World War III, complete peace, right? Those are your two kind of outliers. We're never going to have complete peace with Iran. They're not going to fall in line and just say, okay, we give up. That's not them. On the other side, they also don't want World War III. They don't have the capability to fight it. So the reality is the vast majority of probabilities lie somewhere in middle ground that, this is potentially a very limited event, and there will be some retaliation, and then that'll be it. The other probability is that this incurs more strikes, things heat up a bit before they cool down. This will pass. The only question is how contentious does it get before negotiations occur and everybody goes back to the table? Because eventually that's where this ends up. This ends up back with everybody sitting down at the table and negotiating a new treaty for whatever it is. That's where this likely ends up. That's the high probability of that. The question is just simply the timing and what happens between now and when that event occurs. And how does that impact the markets? And again, the most likely impacts to markets are going to be higher oil prices, a strong dollar, and potentially weaker equity markets. That's what history tells us. But that doesn't mean dramatically weaker equity prices. Again, if we kind of go back in history, and we did this last week as well. So I wrote an article last Monday about Iran and Israel and kind of went through some of the analysis of what happens historically. And I posted in this table. This table is previous events going back to 1940. And sorry, my graph changed here. So this goes back to 1940, and generally markets wind up higher over the coming months. Now, there's certainly a few outliers in there where you had bigger equity declines. For instance, like the USS Cole bombing. That bombing occurred in the middle of the dot-com crisis. So the decline had much less to do with the USS Cole bombing than it did with the unraveling of massive amounts of speculation in the financial markets. We talked about this last Monday. So again, you've got to make sure that you not only take the event when you're doing this analysis, but apply that event to what else was happening within the markets. But more often than not, equity prices wind up higher over the course of the next 12 months than not. And that's because a lot of these events, as I was saying earlier, have nothing to do with earnings in the U.S. And again, this is the important concept to understand when you're thinking about these events and you're trying to focus on what's going to be the impact. This is obviously very unnerving, right? And as an equity investor, it's one of those big levels of uncertainty. Like, what does this mean? But the thing to step back is, okay, this happened, right? The U.S. bombed nuclear facilities in Iran. How does that impact the earnings of the companies that I own? So if you own, for instance, defense stocks, Raytheon, Lockheed Martin, etc., that event potentially benefits those companies. It improves their earnings. Companies that you may own like Royal Caribbean or airline stocks of companies that particularly have routes that go to Israel and Iran and those type of things, right? There's going to be less people wanting to go there right now. So those stocks will likely experience a reduction of earnings because of this event. What does this event have to do with NVIDIA, Apple, Microsoft, Google in terms of their earnings and the whole AI build-out infrastructure issue? How does this event affect those companies? This is the exercise that you need to do with your portfolio. Now, if you're just buying an index, a passive ETF, and your portfolio is just, I'm long S&P 500 index, I'm long, various ETFs, then you need to think about just the more kind of global macro impact. In the short term, maybe some negative events to the overall market. Long term, probably not. But this is the exercise we need to step through. How does this event affect the one thing that drives the markets more than anything else, which is how do investors today value the market based on forward earnings expectations? Does this event change forward earnings expectations to a great degree, or to a degree enough that investors need to revalue what they're willing to pay for an S&P 500 index? That's the exercise we need to work on. Now, historically, and again, this is a chart of the S&P going back to 1900, actually 1871, with events labeled on it. And again, there's certainly short-term impacts. I mean, you can look at when the Libya bombing or the intervention into Lebanon and the Panama invasion, and certainly look at there and say, yeah, there were certainly some short-term clips to the markets. But again, as longer-term investors, what did that mean? And again, you have to take some of these things and put them into context. For instance, like the Vietnam War certainly had some market drawdowns along the way until we got to 73, 74, where you had a very large market drawdown. Black bear market was called back then. But that didn't really have anything to do with Vietnam. That was the popping of the Nifty 50 bubble. And we had surging oil prices because of the oil embargo, et cetera. So there were other impacts that caused that much bigger drawdown in the market. It really wasn't the Vietnam War. So again, it's always important to put these things into context and keep perspective and kind of understanding the interplay. But what this all comes down to at the end of the day is, how does it affect earnings?
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.